Financial literacy information on digital credits. Hello. Today we want to inform you about loans and empower you in your financial decision-making. We want to help you understand the terms used in borrowing digitally on your mobile phone devices. Options for digital borrowing currently available are, for example, M-Shwari, Fuliza, Tala, Branch, O-Cash, or even the recent Hustler Fund that was introduced by the government allowing Kenyan citizens to borrow money through their cell phones, digital lending platform. We will take an example to help illustrate our information. Imagine, you have been facing financial problems and you need some quick money solutions to help you run your activities. You can and want to choose a mobile loan, but you are often subjected to loan conditions that are not easily understandable. In order to help you understand some terms associated with financial literacy and borrowing, we take you on a small journey to help you understand the terms used in digital lending. Understanding interest rate. Suppose you want to borrow Kenyan shillings 10,000 for a month. Digital loan provider B informs you that you will be charged an interest rate charge of 2% per month. Digital loan provider D offers you an interest rate of 15% per month. These are the first steps you need to understand. What does interest rate mean? What interest rate is more beneficial for you? 1. What does interest rate mean? An interest rate is a rate a lender charges a borrower calculated as a percentage, as a proportion, of the amount loaned, or borrowed, principal amount, due per period specified. Interest rate does not include any other fee that may be charged and is strictly the cost of borrowing the principal amount. To inform us better, we compare interest rates below in percentage and absolute figures. Did you know that in case you have been offered the following loans, AD, the higher the amount in percent the more you have to pay in an interest rate? Loan provider B offers you the loan at 2%, which is a lower cost compared to loan provider D who offers 15%. What this means is, you only pay 200 Kenyan shillings in interest for loan B after the 1 month. While, for loan D, you are required to pay 1,500 Kenyan shillings in interest after the 1 month. These are simulated examples to help guide the respondent. In savings, however, your money earns a better interest if, when the interest rate goes higher as compared to the example above in picking a loan. While saving on Platform A, you earn a lower interest rate of 0% compared to savings on Platform D, offering you a 15% return on your savings. In this example, when saving with Platform A, you do not earn any money on top of your savings per month. This means with the 15% rate offered for saving with Platform D, you earn 1,500 Kenyan shillings on top of your savings per month. Other terms used while borrowing that should be looked into is what time period the interest rate specifies, which can be either daily, monthly, or annually. So, we now seek to understand the difference between daily, monthly, or annually, yearly interest rates. Here in our example, the digital lenders offer you a loan that you need to service once after the specified period of time, upon maturity. But the providers calculate the interest rate that they offer you either daily, monthly, annually. What this means is, in this example, you borrow a loan of Kenyan shilling 10,000 for 1 month and you have 3 different options in the interest you are charged, either daily, at 0.7%, monthly 10% or annually 20%. On a daily interest rate of 0.7%, your loan attracts daily amounts, making it expensive in our example. After a month, you end up repaying much more despite the interest rate appearing smaller in numbers. We need to understand here that in the above example, it is clear that despite the yearly interest rate having a bigger figure of 20% per year, the amount you have to repay in a month is much lesser compared to the other interest rate offered with smaller figures. Service fee. When picking a loan, sometimes you are subjected to different other charges, for example, service fees, handling fees, etc. The charged service fee is deducted from the loan amount to be sent to the mobile money wallet, or sometimes it is included in the amount you have to repay. This means you will repay a higher amount than the amount that actually is paid out to you. Like in the example below, When borrowing digitally, a percentage of the principal amount, the amount you ask to borrow, is charged only once in case of a service fee. For example, if you borrow Kenyan shilling 10,000 and you are charged a service fee of 5% Kenyan shilling 500. Option 1. You would receive a lower amount than what you borrowed on your mobile wallet. This means that you are going to receive Kenyan shillings 10,000 minus 500 equals Kenyan shillings 9,500 on your mobile money account. Option 2. You would receive the amount you borrowed, but you will be required to pay more when repaying. This means that you receive Kenyan shillings 10,000 as borrowed but repay Kenyan shillings 10,500, besides the interest rate charges calculated separately. Simply, the higher the percent, the more service fee you are charged. Take our examples on loans AD above. Loan provider A offers you a service fee charge of 0%, which is lower than loan provider D, who offers a service fee charge of 10%. What this means is, you do not pay any service fee for loan A, while, for loan D, you are required to pay 1,000 Kenyan shillings as service fee. We hope this financial literacy journey will help you make informed decisions.